Hello, this is the capital structure problem video. In this video, we'll be looking at how companies will finance their activities through debt or equity. We'll also be using a variety of ratios. Usually, this is looked at from the debt to equity ratio or the interest coverage ratio. If you'd like to follow along with this video, you can do so by downloading the Excel file. You'll also find that the solutions are in the next tab over, so if you need to reference those, you can. Problem number 1, XYZ company has a debt to equity ratio of 0.11. So what should the company do? With a debt to equity ratio of 0.11 or 11 cents per $1 of equity, I would suggest that they would have taken on debt because they don't have very much of it, in the sense of just looking at the debt to equity ratio. So we'll go ahead and take on the debt, or do number A, letter A. Number 2, Miller and Joe Company has a debt to equity ratio of 1.2. What should the company do? In this example, there is 120 times what there is of equity. So they have $1.20 for every $1 of equity, so $1.20 of debt for every $1 of equity. So I'd advise that they don't take on more debt because they have a lot of it as it is. Number 3, a company, so ABC company and XYZ company have a debt equity ratio of 0.96 and 0.5 respectively. What company is better suited to take on debt? So in this example, the lower that this ratio is, the better. So we'd go ahead and say that XYZ company should take it on because their ratio is lower. So they have less debt per equity. Number 4, company ABC has $350,000 in total debt and $450,000 in equity, and company XYZ has $700,000 in total assets, 1/3 of which has been financed by equity and 2/3 of which has been financed by debt. Based on their debt equity ratios, what one would be more suitable? So in this example, we need to calculate debt to equity. So it's just as it sounds. So it's your debt. So this total debt so we're going to do ABC company first. So we're going to take the debt of $350,000 divided by their total equity of $450 or $450,000 and get 0.7777, or they have 78 cents per $1 of equity, so 78 cents of debt per $1 of equity. And then in this example, so XYZ company has a total assets of $700,000, but we're given that 1/3 of it was financed by equity and 2/3 was financed by debt. So if we were to just find out what their debt to equity ratio is, it would just be the 2/3. So 2/3 or 0.666, or they have 67 cents of debt per $1 of equity. So in this sense, company XYZ is the better choice for taking on more debt, or giving them, because they don't have as much debt as at this time. Number 5, given the following data, calculate the interest coverage ratio and decide whether the company should finance its future activities. Assuming debt is available and the companies looking to finance their future activities are just concerned with interest. So to calculate the interest coverage ratio, it is simply the interest expense divided by the operating income. So 0.8, so they have 8 cents of interest per $1 of income. So this is a follow-up question. After your calculations above, where would the company finance their activities? We'd go ahead and say debt because this is pretty low. 8 cents per $1 of income as of that point. And then number 7. So given the following data, calculate the debt equity ratio and decide where the company should finance future activities, assuming debt is available and companies are only concerned with their equity standing. So to figure out what the debt to equity ratio is, we have to do a little bit of math. So to start it, we just need our total debt as of right now. So that the bonds is the only debt instrument at this point. And then we need our equity portion. So as you would know from the accounting section, equity is made up of common stock and retained earnings. And you would find that the debt to equity ratio for this problem is 0.47. So they have 47 cents of debt per $1 of equity. And then the follow-up question after calculating the above, what should they do? In this sense, we're going to take on debt because they only have 47 cents per $1 of equity.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.